All right, guys, welcome to another edition of the Sales Beast podcast. Once again, today we do not have a salesperson here with us. We have the incredible Cherry Chan. In my opinion, one of the best real estate focused accountants in all of Ontario, and she does my taxes, and I could not be happier with everything her and her team has done for me. So Cherry, thank you so much for joining us. I can't wait to spend the next half hour talking to you about and sharing and having you share your knowledge with us.
Thank you so much for having me. It's hard to believe that people want to talk tax for half an hour and an hour long, but yes, I'm happy to talk about tax for an hour with you.
We don't need to go too deep. Tax is, it can be boring, but if you can share some tools with us about how we can potentially save some money and pay less money to the government, I'm sure our listeners will be very happy with that.
Oh yeah, absolutely. I'm in that all day long. That I can talk about all day long.
Yeah.
Cherry, before we get started, can you maybe just give us a glimpse into who you are? Tell us a little bit about your background so our listeners know where you come from and what value you're going to provide us today.
Awesome. My name is Cherry Chan. I am a real estate accountant. I have my own accounting practice that primarily focus on working with real estate agents and real estate investors. I would say that basically covers 100% of my clientele. I work with over 300 clients last year, and majority of them is real estate investors and real estate agents, and a lot of them a combination of both, because they're both, probably both of them. A lot of us would start off with buying real estate, and then they turn into realtors, or they become licensed real estate agents, and then see how crazy the market has been and see how much value the real estate properties or real estate investment would provide in terms of creating the wealth, and they jump into investment. So majority of my clients are in that space, and I started my practice since 2014 officially. Before that, I was working on and off with different smaller clients. I graduated from Waterloo. I got my chartered professional accountant. Back then it was called CA, it's called Chartered Accountant with Waterloo Master of Accounting. And I worked with Deloitte at one point, working in their small business group, working with small business clients. And that's basically my background. Of course, I'm also a real estate investor myself. I love investing in real estate. That's the only thing that guaranteed to go up the last little while. Stock market has been like going up and down. The real estate market has been going up nonstop. The last thing that I do is that I want to mention is that I'm also a real estate agent, licensed real estate agent, although I'm trying to get rid of my license now. There's no point for me to have a license. But I am a licensed real estate agent, just so that I would be able to split income with my husband at the time.
Yeah. Okay. You do a lot. That's impressive. You must be very busy. And I know, so one of the reasons we wanted to have you on, and I'm sure you've been very, very busy with this over the past 5 months or so, was to talk about the PREC. So the ability of realtors in Ontario to now incorporate. Can you talk to us a little bit about that and let us know how that works and what value there is to realtors looking to incorporate?
Absolutely. So just to backtrack a little bit, when I first started, I got my license as a real estate agent. And then in the very first year, I was able to generate six-figure income in terms of commission. And then at the end of the year, I tally up all my expenses, and I deducted and did my tax return, because I was trained and I'm licensed to do my tax return. So I decided to do my tax return. And it was then I realized, hey, like I have to pay out $20,000 to CRA. It was a shock to me. I wasn't planning ahead. I didn't have the money at the time, because when you first start out, you have this employee, at least I did. I had this employee mentality. I could spend everything that's in my bank account, and it turns out I have to save some for HST and save another portion for income tax. So I had to go out to do a couple more deals. And then I realized, hey, like there's other ways. There are other business owners, at least from my personal experience working in the accounting firm, that set up corporations to shelter their business income into the corporation. And I was trying to desperately look for that solution, trying to see if real estate agents are allowed to incorporate. And back then it was early 2000, maybe 2012, before I set up my accounting firm. There's no other options. The only option to set up corporations to shelter all the real estate agent income is to set up something called a sub-brokerage. I don't know if you're familiar with the term sub-brokerage, but that's a loophole in the system to allow real estate agents to earn their income all in a corporation. Now, why do you want to set it up all in the corporation, earn all your income in the corporation? For high producing agents out there, they don't need all the money in their personal name. And when you report everything in your personal name, personal tax system in Canada is a progressive tax system. What it means is that the more you make, the more you have to pay. So using a quick example, from $0 to $13,000 that you net, you pay $0. If you only report $13,000 income, you pay $0. Between $13,000 to $45,000, you pay 20%. It's just 45 minus 13 times 20%. That is how much you would have to pay. So it keeps going up by chunk by chunk. It's called marginal tax rate system. So the highest marginal tax rate in Ontario is is anything over 220,000. You have to pay 53.5% to the government. So for additional $10,000 commission that you make, the government is going to keep 53% and you get to keep 47%. It's pretty sad. So this is the reason why I have always been telling my client, hey, like you gotta set up a corporation. And back then it was hard to tell my clients, any of my clients to set up corporations. I've been bugging one of my clients to set up corporation by writing the broker exam, by writing going through paying the sub-brokerage fee, and it's still worth it because he's making so much. And we weren't able to get it, and Rico has been trying to get it done over the number of years, and finally during COVID year they started allowing that and have the legislation pass through, and so realtors started in Ontario are now allowed to set up their own corporation without having the brokerage license, which is a big win. Now, when I mentioned earlier that the personal tax system is 53.5%. But the reality is when you earn that same $10,000 income in the corporation, you only pay 12.2%. So 53, 12.2, 40% easy tax saving within the corporation. Now, it's not a true tax saving, but it is something that you don't have to pay to the government. You can keep that extra 40% that you would otherwise pay to CRA and invest for yourself. You can take it to buy a condo. You can take it to buy, I don't know, Disney stock. And it will grow it for you within the corporation environment. But if you take it out from your corporation, you will then have to pay personal tax. Essentially, you're taking what you would otherwise pay to CRA just to invest for yourself for your own benefit.
What did you say, Chair, that cutoff number was? At what point, what income level does it go up to 53%? You said 200 and...
It is 220,000 over, maybe it's indexed up a little bit this particular year. I have to double check. But generally speaking, is over $220,000. You have to pay 53.5%.
Okay, so a realtor, for instance, making $1 million a year for simple math.
Yes.
In the past, they would have paid 53% on approximately 800,000 of that. You're saying now they set up a corp and they pay 12.2% on that amount. And as long as it stays in the corp?
As long as it stays in the corp. Okay, so it is still $220,000. Now, but to answer your question, because you throw $1 million there, so $1 million is a lot of money. Now, so first of all, I have to clarify that this is applicable only to the net amount. So it's your expense, gross commission income, your GCI, minus whatever that's qualified deduction. So that would include all your advertising, like coaching expenses, brokerage fees, advertising, everything there. So it's the net amount that's being taxed. So your net amount has to be over 220 to pay 53.5%. But even if it is under 220, you would still pay a substantial amount to CRA, close to 50%. Now, the 1 million, if you do net $1 million, I hope you already set up a corporation. If you do net $1 million, it's not going to be purely 12.2% because the first $500,000 is subject to the small business rate, which is 12.2%. If you earn more than $500,000, now you're going to be in a tax bracket, a different tax bracket in the corporation. You consider a larger corporation and you're being taxed at 26% instead of 53.5%.
Okay. So up to 500,000, 12.2, anything in excess of 500,000 taxed at 26.
Yes. And $500,000 is net and it's annual.
Yep. Mm-hmm. So huge savings across the board. Now, I know before we hopped on a call, we were having a conversation. You were telling me it doesn't make sense for every realtor to incorporate. Why is that? And when does it make sense for people to start thinking about incorporating?
As you all know, some of the average agents do not do a lot of deals. And depending on the circumstances and the amount that they're generating, it may or may not make sense for them. The reason is that even though you set up a corporation, you can pay as little as 12.2%, you still need to draw money out to live. And those, you would have to draw money out from your corporation. And your corporation is considered a separate legal entity. When you draw money out from the corporation, just like you receive dividend from your TD Bank stock investment, you draw out as a dividend and TD Bank would issue a T5 to you at the end of the year. And so you have to report that dividend as your dividend income. So you have to pay personal income tax on the money that you draw out. And you draw money out, you need to, because that you have to live off some assets, live off some cash flow. So it really goes back to your personal lifestyle, how much you need to spend in your personal life. Now, we're saying on average, if you have you net $150,000 and you really need only $60,000 after tax to live off for your personal expense, which is pretty generous for $5,000 a month. If you only need $60,000, you really only need $67,000 drawn from the corporation to your personal name, and you have substantial amount of tax saving. In that situation, I think every year you would be able to save or defer $20,000, $25,000 tax just by setting up this structure on its own. Now, but let's say you are the one that spends a lot of money and you have a stay-home spouse, and let's say you also have 2 kids that are in private school. You need the entire $150,000 to live off in your personal name. So you know, like you need way more than 60, you need the entire 150. Then there is no point because there is something called tax integration in Canada. What it means is that whether you report the income in your personal name or you report the income in the corporation and you take everything out from the corporation, the amount of tax will equal to each other. So you use a corporation structure and take everything out versus you own the business in your personal name and pay all the tax. The net amount would be more or less the same. That's called tax integration in Canada. The only difference is that if you don't take out everything, you take out just a little bit and invest within the corporation structure and stretch it amount the rest of your life, and there could be significant tax deferral available. And that's the reason why it's case by case. It really goes back to your spending habit, your life situation, like who you marry, do you need to support that person, or you may need to support your parents and you really need to take out a lot, or you have a huge mortgage. Those are all the factors that come into play.
So now on the investing front, because you come from that background, what are the implications in investing either in stocks or in real estate through the corporation?
So there are a few. Now, let's start with the easy one, stock. Stock is pretty simple, straightforward. Using the example that I had earlier, if you earn net 150,000 and you just pour 67,000, you have significant amount, $20,000 extra that you would otherwise pay to CRA. Like you could just invest within your corporation to buy stock. It could be just buying stock, whatever stock that you want. Now, the money that you put into the stock market there would be either capital gain that you would earn, assuming that you're buying it for an investment, long-term investment purpose, and there would be like dividend income that you would earn. So dividend income that you would earn, you would then be able to dividend income that you would earn, you would be able to report it in your corporation tax return. It is on a higher rate. I think it's at 50%. But however, if you take out, if you report that dividend income and take out dividend income from the corporation, you'll get a tax credit back. So it is not the it's not the end of the world. You will still be paying a little bit more, but you get a much larger base to invest with. In terms of capital gain, the same way, it's being treated the same way. 50% is taxable, 50% is not taxable, the same as in your personal name. So again, because of tax integration, you're not losing anything at all compared to investing in the corporation. Now, in terms of whether you need to set up a corporation separately just for stock investment, I don't think so. You can just put it directly inside the same corporation, unless you do a lot of active trading and you want to separate the risk. Unless you have like maybe $1 million or $2 million accumulated in the corporation and you want some risk segregation. If you know, like in the real estate business, real estate agent business, who knows what happened next? And sometimes there are some rulings that are not necessarily fair to you. And so you may want to just invest in a second corporation just to protect your cash. And that may be the reason why you would want to set up a corporation. But for tax reason, there is none to set up a second corporation. Now, in terms of investing in real estate, I feel like I'm talking a lot. Mike, do you?
This is good.
This is good.
No,
We're
this
learning.
is amazing.
In terms, okay, I'll continue with real estate. So if you buy investment if you buy real estate inside the same corporation, in the personal real estate corp, you're allowed to do it, but it gets a little bit trickier because I came from that background, so I can speak to that a little bit more. So typically when you buy real estate investment, you want to borrow money to like you would want to have a mortgage against your property, because the beauty of real estate is the leverage. Stock, you don't have any leverage, but real estate, you have the leverage. You just need to pay the down payment. So typically you want to go to a traditional bank and say, hey, like I have this PRAC and I want to buy the property in this corporation. The challenge is that the bank would not like to loan money to a corporation that has active business income. What's active business income? Active business income is the real estate agent income. It could be the consulting income. It is my accounting firm income. So if I take my accounting firm and say, hey, I want to buy a property, qualify for financing, they would use my income from my accounting firm to qualify me, but they don't want to lend it to that corporation that has that active business income. Now, don't ask me why, I'm just a messenger. I've gone through the whole process to qualify for financing, specifically with RBC early last year, and they approve everything. And then the underwriter, the initial approving underwriter went on vacation. So then they passed to the second underwriter who noticed that I had $2,000 consulting income in the holding company. It was set up a long time ago, and you would have thought that, okay, having that $2,000 consulting income is better than not having the consulting income, because it helps to pay down the mortgage and everything. And no, they pulled the mortgage approval based on that $2,000 additional consulting income on the basis that they don't lend it to any company that's not holding company. And by their definition, the bank's definition, holding company has to be the company that only owns real estate. So that is the reason why I would not put it in the same corporation if you're planning to buy a few more.
So just so I'm clear, if you're looking, so it's very challenging to buy real estate within the corp. You would have to pull the money out of your corp in order to invest in real estate, which I imagine you'd incur.
No. Sorry, I misled you guys. You just need to, you can buy it in the corp. You just have to set up a second corporation that doesn't have active business income to own the real estate.
Okay.
Yes, and you don't take the money out. If you take the money out, then you defeat the purpose of setting up the PRAC.
Mm-hmm. Yeah. Okay. Yeah. Now, how, say Anna and myself are looking to go out and purchase a deal together, and we need more advice on this and we need someone to actually set up the corp for us so we can go purchase the property we want to buy, can we reach out to someone like yourself and have you set that up for us and guide us through the process?
Yeah, absolutely. Our team help our clients set up corporation structure for real estate investment as well as prep. So we specialize in doing it all. By all means, you can reach out. You can find my information on realestatetextips.ca or reach out to us on our website. Our email address is there as well.
Okay. I have a question for you. So in my business, I do a lot of joint venture partners. So I partner with someone that maybe doesn't have the knowledge or tools to buy real estate. I do a lot of the work. They provide the money. But sometimes I do put my own funds in these deals. Is it possible for the name of the PREC to be on my joint venture agreement versus my personal name and invest the funds from my PREC into these JV deals?
Absolutely. So even whether or not it is in your PREC or in a separate corporation, you can still use the fund in your PREC to pay for the investment in these joint venture. Now, like I mentioned earlier, it would be really hard for you to get financing if you put it also under your PREC. So that is one consideration that you need to pay attention to. You are totally, from a tax perspective, from a legal perspective, you are allowed to use your PREC to be the joint venture partner with your partner, especially if your partner is the one that's qualifying for financing. Now, it's just that there are two considerations. One is, in the future, do you want to like, if you are the one that's going to qualify for financing, that may not be beneficial. Number two is that like I mentioned earlier about stock portfolio, if you have a large enough real estate investment and you use your PREC fund, you use your PREC to be forming that joint venture relationship, you may be exposing your joint venture investment to your realtor business risk. And that's what you may not want to put it in. That's why you may not want to. If you're comfortable with your business, with your real estate business, then it's fine. You can put it all in PREC.
Yeah. Okay. That makes sense. No, you answered my question. Anna, you have, I have more questions. I've been talking a lot though. Do you have anything?
I've been taking notes just for my personal reasons. So I don't have questions, but I'm excited to keep kind of listening. Go ahead with your questions, Mike.
Yeah, so it's funny. I have all this money going into my corp right now. My wife not yells at me, but once a week, she's asked me, how do we pull money out of this thing? And my answer is, I have no idea. Let's just leave it there for now and I'll figure it out later. So what's the best way to pull money out? Do you draw a dividend? Do you just treat it like a salary and consistently pull cash out of there every couple of weeks?
Regardless whether it is salary or dividend, I would always draw it out on a consistent basis. So the first basis is we go back to the original calculation that we did and look at how much you really need in your personal need. Like, let's say it's $5,000 or $10,000 a month. Now, then we decide to take that $10,000 a month out from the corporation. Now, before I even go there, what I would do is that I would go back to your corporation and set something up. I know this is a crazy system that I'm going to tell you, but I've been implementing it in my own business. I'm sure a lot of you have it. It's just I'm just that accountant that really ashamed. Like from 5-10 years ago when I was a realtor and I had no money at the end of the year to pay for CLA's bill. So now I've set up a system, which I call, I think some people call it an envelope system. Essentially, for every paycheck that comes in, I would, on a monthly basis or bi-weekly basis, I would go into the bank and take that money and divide it into 4 different bank accounts. So let's say it's $10,000. I would set up 5 different bank accounts. The first account is called income account. So you deposit your commission check into the income account. Okay. And then I would also have 4 additional bank accounts. Okay. The second bank account is called operating expenses. So that account is used to pay all the operating expenses. And then the third account is called profit account, because as a business, you want to have profit. So it's a profit account. The fourth account is called owner's compensation account. So you're the owner. So this is really where you draw all your money out from. It's to pay you. And then of course, we're in business and there's no way to escape CRA. I set up this system, there is CRA, so there's a CRA account. So typically what I do is for every 2 weeks, I'll go in and look at my deposit. I don't know if your brokerage use the automatic deposit. Let's say we do the automatic deposit. Let's say they give you $10,000. Okay, a commission check deposit, $10,000. So I would then reallocate a portion to the CRA account, a portion to each of the account operating expenses, owner's compensation, profit, and CRA. So I take that 10,000 every month is the same allocation, same portion. In my own accounting firm, this is how I allocate it. You don't have to follow it, but this is a sample percentage. I allocate about 60% of the incoming cash flow to the operating expense because I have payroll and all that. And then I allocate 15% to my owner's compensation account, and I allocate 15% to my profit account, and I allocate 10% to the tax. Now, this tax account includes HST, it includes also income tax for the owners. So including that for your personal taxes as well. So these are all the accounts that I set up. The percentage is not set in stone, okay? You would need to adjust it at the end of the year and see based on the amounts that of taxes that you would have to pay at the end of the year to adjust it accordingly. Annually, you have to update that percentage allocation. But by doing that, I would have an account saved just for CRA's money. Now, I would then set up a schedule to draw money out from my own compensation account on a regular basis. Now, initially, you could do it on dividend, or you could choose to do it on salary. Now, the biggest difference between salary and dividend is that salary requires a consistent monthly payroll source deduction pay to CRA. So you have to remit monthly to CRA. That's the biggest thing. And then at the end of the year, you also have to do a T4 reconciliation. And then you tell CRA, hey, like I pay you this much for the last 12 months for the payroll, and I pay my staff this much, the net amount, all of them add up together, it reconcile, here's a T4, and then you give the staff the T4. And in that case, the staff is you, or if you, in the future, like it sounds like your wife is also a part of the business, then if you pay your wife a salary, then you would also need to have her on the T4 as well. So that's one way of doing it. Now, the second way of doing it is by way of dividend. Dividend is a lot easier. Dividend, essentially, you just draw it out on a monthly basis. And then at the end of the year, we file something called T5. Now, you don't have to pay taxes per se immediately, but you would have to pay the tax in your personal name. At the end of the year, when you file the T5 on your personal tax return, we tally out and then calculate how much you would have to pay. Now, typically at that point, we pay it through the corporation tax account for you, and then we declare that also as your dividend income. So essentially, dividend has less filing obligation, not a monthly obligation anyway. Salary is more, has more obligation, onerous responsibility on the operator, owner. That's really what it is. Now, there are other factors. Like for example, at the beginning, I always encourage my clients to do it the dividend route. It's easier. Now, but there are, if you're in the buying mode, trying to buy more property, investment properties, you may want to have salary. Have that conversation with your mortgage broker, because sometimes mortgage broker prefers to see a salary instead of dividend, because then they can qualify you for financing immediately versus dividend. They may say, oh, I need 2 years of your last transaction or whatever, last 2 years of tax return to average you out. But if you pay yourself a salary, you may or may not need that. So those are the factors that goes into that are beyond tax that you would consider before making the decision whether you pay yourself salary or dividend. But regardless, I would do the monthly withdrawal fixed amount, so it helps you with your personal budgeting as well.
Okay, and is there a tax advantage to dividends versus salary, or salary versus dividends, or do you pay the same amount?
They are pretty much similar. The only difference is that you will lose the CPP. So when you pay salary, the employer in this situation is your prac. Your prac would have to pay CPP, employer's portion of CPP, which it's right now up to about $2,500. That's in addition to the salary, the dividend that you would have to pay. You lose out on the CPP. That's pretty much what it is. When I say lose out in quotation, because at the end, like when you reach the age of 60, you can also claim your CPP back. But it's essentially contributing to your own Canada pension plan. If you don't believe in Canada pension plan, why put away that much money with the government, right? You really don't know whether you're going to, like anyone will qualify if there will actually be a CPP plan by the time we get to the age of 60.
Yeah. No, that's awesome. You answered all of my questions. Anna, you have anything?
No, again, I was just taking a bunch of notes. Like, I'm definitely a lot newer to that side of the business. And I'm sure there's tons that we could probably dive into, but this gives us a very high level overview of at least the prec side of things. Is there anything that you want to focus on too, or any kind of advice that you would give to realtors, both new or experienced?
I think that cash budgeting thing is very important. The bank account thing, if you don't have that set up already, should definitely set it up. The one thing that I forgot to mention, that method is not invented by me. It's by a book called Profit
First.
Yes, Profit First. And you hide those tax accounts, hide your profit accounts, so you don't touch those accounts. It saves my back. For sure, in terms of tax bills and everything. So for that, I'm always grateful for the book.
Awesome. That's by Mike McAllowitz. I read that, and he did a speaking engagement for one of our divisions. So
yeah, that's awesome.
Yeah, he's awesome.
Yeah. Did you implement that system?
For Corps, yes. Personally, I'm still working on it.
I know, I'm also working on it personally, but it's been a few years. At least the CRA bills is taken care of. I don't owe anyone any money.
Yeah, I think that's the biggest thing, especially for realtors. They don't think about that right up front when they get into this industry. And then it's like a year later, tax time comes up and they're struggling to put all those funds together. So starting early is important, or even just starting now, if you haven't done that, is hugely important. Now, Cherry, where can people get a hold of you? Like you mentioned your website. Do you have an email or somewhere where people can reach you?
Yes, so you can call our office. Our office is about 416-548-4228. Our office is located just west of Toronto at Oakville, Trafalgar, and QEW. We do a lot of Zoom meetings with our clients as well these days. Like we don't have a choice, we just do a lot of Zoom meetings. So that's another way to set up meetings with us. We have an email address. You can reach to my office at me@cccpa.ca.
Awesome. We'll put all that contact information.
You guys totally need to reach out to Cherry's team. I know people in your line of work, they get very busy around so-called busy season, and I just found you guys to be so available. So much so that you were bugging me to get my documents in, which I appreciate so much.
I don't know if that's a good thing. If you feel that
it's amazing, because if I didn't keep getting these repeated emails from you guys, I would have never done it. And I'm used to, like, sometimes you get the opposite experience with accountants that are really busy during that time of the year. So I give you guys an 11 out of 10 in terms of customer service.
I'm going to have to reach out to you then, Cherry. That's a glowing review from Mike.
Yes,
that's awesome.
That's awesome. Thank you. I mean, we work really hard to implement that system, essentially, about our client to get us stuff. So thank you so much.
Awesome. Yeah. One last question that we ask all our guests is, Cherry, who do you know that we should have on this podcast, whether to talk on the financial side or talk on the agent side? Who do you know that we should know?
That's a good question. I feel like you guys would be benefiting from having a sales trainer. There's this guy that we like 2 years ago, back then, before COVID time, once upon a time, we we hosted an event called Wild Hacker Conference, and we hosted Grand Cardone in Toronto. And at the time, we were connected with Grand Cardone Canada. So they have a Canadian division. So the leader of Grand Cardone Canada is a hardcore sales trainer. And I feel that that could be providing some value. And his name's Corey. He could provide some really good value to your audience.
Okay.
Do you, would it be possible to get him on here, or is he such a big deal it'd be a tough sell to get him on the podcast?
No, I don't think so. I think you would be able to get him on your podcast. And he now, I believe he now moved from Vancouver to Florida. So
Okay.
a good story, a cool story that he has. I'll send an email to connect the two of you.
That'd be amazing.
Amazing.
Yeah.
Okay.
Yeah. Awesome.
Thank you very much. Everyone listening, reach out to Cherry. She'll take very good care of you. Hopefully save you lots of money, get your prep set up. And yeah, thank you so much, Cherry, for your time today.
Thank you, guys. Appreciate the opportunity.
Thank
Yeah.
you. Take care.
All right, take care.